Let's take a look at emerging markets right now on Trading Nation. Now, so far this year, the emerging markets ETF, the biggest one, there's many, but the big one, the EEM, is up 17%. That is almost 3 times the amount of the lowly S&P 500 ETF, which is up about 6. David Seaburg, head of equity sales trading at Cowen, Max Wolff, chief economist at Manhattan Venture Partners. All right, so David, just a very simple question. Do you keep buying EEM because it's done well, or because it's done well, it's time to sell?
I don't think you just buy anything because it does well or it's done well. I think you got to look forward and see what the risks are. And I think in general, Brian, I think there are some risks going into the end of the year. So I'd trade into the end of the year. Longer term, however, I think it's set up to continue to outpace the S&P, just given the fundamental backdrop of growth in a lot of these emerging markets. And I think generally, I think commodities going into next year are going to continue to do well. And obviously, they're very tied to commodities. So I think that emerging markets is probably a better bet for a longer-term player. Near-term, I'd be trading, them just based on different levels. If we break 3680, I think 3680 is a very important level. One of our technicians here, Chris Pollard, pointed that out. If we break 3680, it could be a full drop down. It could be a pretty, we break some pretty important trend lines there. So keep an eye on that level.
Max Wolff, your view on the emerging markets, the EEM, which, by the way, is very heavily skewed to Asia and China, by the way. Do you like it? Is it still a good value?
We sort of like it, but when you buy the EEM, what you're really buying is a whole lot of exposure to Chinese tech, particularly,
exactly,
including Chinese internet stocks, which are partly looking so strong year to date because they really underperformed most of the other benchmarkable type of ideas you could do in the same space. American tech is definitely frothy. Chinese tech looks a little frothy, although less. Longer term, we like the EEM space, even though we think that there's going to be much more risk factored into the markets going forward. And the reason is we've had a little bit of a rerun of 99 lately, which is money is flooding to the U.S. as a safe harbor, a relative safety play, and it's going to U.S. tech. So some of the other tech companies were cheap. Part of what we're seeing with EEM is people crowding into that. We do think longer term, obviously, the larger growth rate is going to be in the emerging market space, but we have a feeling you can get in there even cheaper in the future because the return of risk will always hit hard on markets that not always fairly, but are generally associated with a higher risk level than developed economies. But I think we're seeing a little bit of a rotation because people are kind of trying to get out of parts of Europe and parts of the UK, and that's going to just force them to push into China and the US more.
Sell a British bank, buy a Chinese internet company. Makes perfect sense. Max and David, both thank you very much. A look at the EEM, which has done pretty doggone well so far this year. For more Trading Nation, go to our website, tradingnation.cnbc.com.
Overbought and oversold indicators, such as momentum oscillators, are generally used differently depending on whether the stock is range-bound or trending. Look to buy a range-bound market when an oscillator, such as the RSI or stochastic, falls into oversold territory and then moves back above it. And look to sell a range-bound market when the oscillator rises into overbought territory and then drops below it.
Hey CNBC fans, thanks for checking out our YouTube channel. Here you're going to find videos packed with all of the information that you need to be smarter about your finances. You can subscribe by clicking right here and click on all the videos around me or the eye right here to watch the latest from CNBC. Thanks for watching.